Good morning. We are going to present the case of Whole Foods. The case is about that Whole Foods went on to face competition from wholesalers and other low-price sellers who will have resumed the shares of conventional grocery stores in dollars for more than a decade. For example, Walmart, Kroger, and others launched organic offerings targeting health-conscious consumers at price lower than natural grocery stores. The consequence was that the color resource of Whole Foods caused attachments to the analysis by the collapse of the price of the actions because the increase of competition in the grocery industry was not new for the company, which despite increased competition had maintained its favorable margins and high growth for years. But for 2013, the situation changed. The growing competitiveness would have left the company at the risk of reducing its margins and slowing its expansion. Next, please. Whole Food strategy is linking to differentiation. And is offer high quality products. The company seeks to offer a combination of natural and organic products that fit with the changing preference of consumers today. It focuses on a small and specific market and each of people concerned about their health and the environment. So it has a system to classify fresh products according to a series of criteria that include sustainability amongst others. For example, it was the only company that sold products leveraging genetically modified products. Therefore, it's not based on competing on low cost. However, to face growing competition, it began to market private brands, which allowed them to offer low prices, will capture sufficient margins, and began to make investment to improve the customer experience, which many consider one of its strengths.
About the Whole Foods industry, the main characteristics are that it's very competitive and have low growth industry. The low margins are very low because of the first competition. The real demand is tied to the population growth. The narrow margins are very limited. The consumers were extremely conscious about the prices and want promotions. The key segments are three: the conventional grocers, the supercenters, and the natural grocers. Then we have a comparison between Whole Foods and the two leading natural grocers. First, we have the EBITDA. We can see that Whole Foods have a higher rate. That means that it's more profitable than the other two companies. Is the only one that have zero in debt. That means that financing by equity or maybe by its suppliers. And finally, in sales have a higher number. That means that is the leader of the market. About the indirect competitors, we have other natural grocers as Costco or Sam's Club, or other companies that start to offer organic products such as Whole Foods that are Kroger and Walmart. Then we have the Whole Foods market position is the clear leader of the natural and organic grocers because have a very huge same-store sales, a huge net income, same as the sales, and have a favorable margins and high growth of rates for many years. But it's sustainable in the next years because Whole Foods faces a scenario in which the competition press the company to compress margins, steal in the market share, and also the same store sales decrease or maybe even decline. So to face that, the company have many strengths such as standard beer and true leader of the industry, the capacity to maintain their targets, the opportunity to adjust prices and reduce operating expenses, and finally to offer private label products. So in conclusion, in the combination of the Whole Foods leaderships in the natural and organic offerings, and also because of the conscious of the consumers to make a decisions in the time that they buy the products, provide ample runway for sustainable growth for the company.
Talking about the past operating performance, in the years that sales increased, like in 2004 or 2008, we can expect that the EBITDA is going to grow, but if the EBITDA is maintained or decreased, like in that years, it can be assumed that expenses and discounts may have increased. In years when the sales decline, like in 2006 or 2013, if EBITDA is maintained, it could be due to the lower expenses or an increase in the depreciation and amortization expenses. So, historical ratios inform that even when the company sometimes increases sales, the expenses are higher. This does not allow EBITDA to increase as expected by sales growth. Also, we don't have to confuse a big EBITDA or a maintained EBITDA with the sales growth. It can be because of the increase of the amortization and depreciation or a reducing the expenses. Next.
About the financial assumptions in the ROA, the ones that are important are sales growth and EBITDA margin because they are directly related to net income growth, part of the ROA formula. Sales should grow to compensate this little margin the industry has, and the EBITDA to show the real profits of the company. Also assets, which in the case is referred to the sum of current assets plus net PP&E. This has been increasing, especially since their non-current assets have grown and represent around 70 or between 60 and 70%. And also the assumptions that play the biggest role to drive the improvements in the ROA are the net income growth, the higher the better, while increasing also the asset turnover ratio because it indicates how efficiently the company uses its assets to generate sales. Next.
Before I analyze the Deutsche Bank for us, what we did was analysis of the historical data of Wolf's food market. First, we evaluate sales growth and also EBITDA margins. As we can see, in fact, the sales actually decreased for the following years, 2014, 15, and 16. However, the EBITDA margins increased. What we assume is that this forecast is based on the idea that the company are going to still have for the following years the same quantity of stores that they had in the 2013. And as Caroline mentioned before, could be the increase of the EBITDA margin because of the increase in depreciation and amortization expenses. Also, to make a forecast for the total stores and the same store sales growth, we use the compost annual growth rate, and we obtain that in any store any store a 7.7% increase in sales for 2014 and 8.4% in 2015. Next, please. Making a comparison between the forecast of Deutsche Bank and what we did, we evaluate that the ratios, I mean the percentage, are different. So we disagree with the forecast of Deutsche Bank, especially because we evaluate the historical data, and what Deutsche Bank did was evaluation based on the years of 2011, 12, and 13. So for us, our forecast is more cautious and reserved about the increase of sales and stores. However, there is a consideration that maybe the Deutsche Bank make a forecast of those numbers based on some data or information that maybe the CEO of Wolf would provide. Because as we know, for make a forecast, any bank any bank asks for more information to the companies. Next, please.
Okay, to answer the question, would you invest in the company? The answer is yes, because both forecasts have a return of capital and earnings per share positive, but at the same time, we understand that stocks fall because people believe they are going to fall, and they rise because people believe they are going to rise, regardless of how the company is being run, whether it will make a profit or loss in the coming periods, or whether the dividends that will be distributed between the shareholders will be big or small. But if there's dividends, we think that that's good enough. Thanks.
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 Thanks.